Straight to the big story of the day. The Chief Economic Advisor-led panel submitted its recommendations on the GST. Here are the big takeaways relevant to us as home buyers. Firstly, standard GST will range between 17% and 18%. The committee has given states two rate options. They could opt for a single rate of 15% or a range of 17% to 18%. But the most significant announcement is the fact that real estate, along with alcohol, has been kept out of the ambit of the all-important GST. Listen in.
Based on our analysis, which of course will become public, that the R&R should be 15%. So we're giving a range, 15 to 15.5, but we're also expressing our preference and view that it should be towards the lower end of that. So that's the first number. This then gets translated into a structure of rates, a low, a standard rate, and what we call a high or a demerit rate on certain, kind of luxury kind of items. The low rate and the high rate are, what we said should be 12 and 40, right? 40, that's the low rate. And now remember, these are all national numbers. So 12 means 6 plus 6. What we've presented here is a range for the standard rate. Now, this standard rate will be the same for goods and services. That rate will depend upon how you tax precious metals. The standard rate will vary between approximately 17 and 18%. If we had the luxury or if the political process decided to have one rate, it would be 15% for the GST. But if you have to have a variety of rates because of social considerations and underlying policy objectives, then you get a three-rate structure of 12 and 40 for the low and the very high rate, and this key standard rate will vary between approximately 17 and 18%, depending a lot on these choices made about exemptions and how precious metals are treated. So this is the kind of key. Now, how this will be allocated between the center and the states will again, of course, be decided by the GST Council, but it's clear that this allocation will and must reflect the revenues to be raised at the center and the states. The committee also recommends that, given that Make in India is so important and that you need to make in India by making one India, the committee recommends eliminating all the taxes on interstate trade, including the 1% additional tax. So I think this is, if you believe in Make in India, this has to be part of that.
And to get a perspective on this, we are being joined on the phone line by Satish S., partner in direct tax at PricewaterhouseCoopers. Satish, thank you so much for joining us here on the news and Magic Bricks. Now, talk to us. Real estate has been kept out of the ambit of the GST. What exactly does that mean?
Yeah, in my opinion, keeping real estate out of the ambit of GST is certainly not a welcome measure from an industry point of view. Assuming that I am in a situation whereby I'm a real estate player and I am outside the ambit of GST, and my vendors obviously will be in GST, so whereby any of these input services that I obtain, or it can be raw materials, it can be capital goods, all these procurements will be part of GST. And the moment I am out of the ambit of GST, these costs will be to my account. These certainly will not be creditable. This will be a cost for me, and hence I would feel that this is not a very ideal thing to do. On top of it, it is not just about an implication of VAT and service tax. Some of these commodities, when I procure, can even carry an element of excise duty. So all these will become a cost burden as far as I am concerned, without a credit being available, being a vendor into GST and I as a real estate player outside the ambit of GST. So this is certainly not a very welcome measure from a real estate company perspective. On top of it, assuming the property taxes remain, the challenge is this property taxes being on land transactions, that is on anything to do with immovable property. This again is going to be a standalone tax, and which again is going to add to my tax implications. Now, if at all at some point the government decides to get real estate into the ambit of GST, even then the question will be of classification, because it has components of service and goods, Will it be classified at a 12% rate, that is a lower rate, or will it get covered under the 17 to 18% band that the government is talking about? So there are implications either way, but assuming that real estate is going to be outside the ambit of GST, certainly it's not a very welcome measure.
All right, Satish, tell us, then I'd like to ask you just one thing. How will this impact the home buyer? I mean, talk to us about that. Will I as a home buyer end up paying even more tax than what I do right now?
My view is yes, because the moment the entire tax system is going to be inefficient for a real estate player, certainly it is going to be part of his cost. And the moment it becomes cost, somebody will have to recover it from a home buyer like you and me. And effectively, it is going to push up the flat prices with this kind of a measure that the government is talking about. And certainly that goes against, the very principle of, what the government is talking about in terms of, more economical housing and, trying to get the real estate prices lower and all that. Certainly, I think this is a contra-measure.
And also, this also means that you're already keeping petroleum products and alcohol out of the ambit of the GST, and now real estate, which is a huge chunk of the economy, being kept away. So do you think that in this sense, the government is sort of cutting itself short by not keeping the real estate industry as part of the GST?
Absolutely, because the impact of this is not only for home buyers like you and me. This can even mean commercial properties, and the moment it has an impact on commercial properties, it is going to impact the entire gamut of business. It can be commercial spaces, it can be office spaces, it can be warehouses, it can be homes. So it is going to have a cascading implication on the entire business of the country. So I would actually urge if the government can do a bit of rethinking on this aspect.
All right, Satish, just wanted to understand one thing before I let you go. What I, as a home buyer, how do I view this, and what do I do? Say, for example, if I'm sitting on the fence and I'm just about to buy a house, should I rush up my purchase or still wait for more clarity on this?
I would actually feel that at this point of time, we kind of wait and watch, because it's only a recommendation today by the CEA. And there's nothing final about it. We'll have to anyway wait for the constitutional amendment bill to be passed in the winter session. The reactions from the opposition and all that. So I suggest we need to wait and watch and possibly look at the fine print, because we've just heard the recommendation of the CEA at this point of time. And I would actually feel that at this point of time we wait and watch. In any case, one major aspect which I would imagine at this point of time is land price, which is a portion of the entire cost, which is recovered from a purchaser of a property, is a major element in terms of cost. And it's a question of how the government wants to segregate the value of land, because here we are talking about taxing a transaction which has an element of movable goods and a bit of immobile property. So there has to be a proper and a robust mechanism to kind of delink the value of the land and the value of the rest of the works contracts to make it in terms of a valuation mechanism, so that it becomes easier for even the industry to comply, and then kind of keep the tax costs at a fairly minimum rate so that there is no cascading effect on the flat buyers or the property buyers.